They say love and money don't mix. I disagree because the IRS is definitely part of your relationship. Whether you are tying the knot or untangling a marriage, your taxes change. Sometimes for the better, sometimes not so much. Hi, I'm Aradhna Agarwal. I am a CPA, and my goal is simple: to help everyday people understand taxes without fear, confusion, or jargon. And today I'm breaking down the tax implications of getting married or divorced clearly, calmly, and with no emotional or financial hangovers. Because love is complicated, but your taxes don't have to be. Let's start with the basics. The moment you say I do, your tax filing status changes based on your marital status on December 31st of that tax year. So if you got married on December 31st, congratulations, you are considered married for the whole year in the eyes of the IRS. You will choose between married filing jointly, which means combining both income and deductions, or married filing separately, where you file alone but often lose key benefits. Joint filing usually means lower taxes because the IRS gives favorable rates and credits to couples, but it also means you are jointly responsible for the accuracy of the return and any taxes owed. So before you say I do on your taxes, make sure your partner's records are clean, no secret tax debts lurking in the background. Now let's talk about something people call the marriage bonus and the marriage penalty, because yes, your love life can literally affect your tax bracket. When one spouse earns significantly more than the other, joint filing can reduce overall taxes. Example, one partner makes $100,000, the other earns $30,000. Filing jointly may push the combined income into a better bracket. If both spouses earn high salaries, let's say $150,000 each, combining incomes can bump you into a higher tax bracket and even phase out certain deductions or credit. It feels unfair, right? But that's how the tax code is structured. So before filing, calculate both ways, jointly and separately, and ask your CPA which route saves you more. Seems simple, but this one trips people up every year. If you change your last name or address, make sure both the Social Security Administration and IRS have the updates before you file your tax return. Why? Because if your name does not match the SSA database when the IRS checks your return, it can delay your refund or rejection altogether. So, new last name, new address, change those forms first, tax return later. When you get married, your paychecks need a little makeover too. Go to your HR or payroll system and update your W-4 form. Why? Because your combined household income might bump you into a new tax bracket. And if your withholding stays the same, you could face a surprise bill next April. The IRS even has a withholding estimator tool online. Use it to figure out how much should be withheld based on the new situation. Review this every year, especially if one of you gets a raise or starts freelancing on the side. Here is where marriage can feel like a financial superpower. As a married couple, you may now qualify for the higher deduction limits, the standard deduction for joint filer, access to IRA contributions. Even if one spouse doesn't work, the other can contribute on their behalf to a spousal IRA. Better capital gain exclusions, selling your home together. You can exclude up to $500K in gains versus $250,000 if you were single. And if you have children, marriage can simplify eligibility for credits like the child tax credit, the earned income credit, the dependent care credit. Love may make your world brighter and sometimes your tax bill lighter too. Divorce is emotional enough, and unfortunately, the IRS does not make it easier. When you legally separate or divorce, your filing status depends again on your status as of December 31st. If your divorce is finalized before that date, you're officially single or possibly head of household if you have dependents. Here is what else changes. You can no longer file jointly or claim your ex as a dependent. You will need to decide which parent claims the child tax credit, which must align with custody agreements. And if alimony is involved, the tax treatment depends on when your divorce was finalized. Before 2019, alimony was deductible to the payer and taxable to the receiver. After 29, nope, for divorces finalized after that date, alimony is no longer deductible or taxable. So if you're negotiating divorce financials, plan with a CPA, not just an attorney. The IRS is the hidden third party in every agreement. Property division adds another layer of tax complexity. Homes. If one spouse keeps your primary home, the transfer as part of divorce is not taxable. But if they sell it later, they will owe tax on any gain beyond their exclusion. Retirement accounts, transferring IRA or 401k funds as part of the divorce agreement can trigger taxes unless it's done under a qualified domestic relations order. Don't skip that paperwork. The IRS doesn't care about your settlement intentions, only the forms attached to it. Here is the truth. Getting married or divorced does not just change your relationship, it changes your entire financial picture. Your income, credits, deductions, estate plans, and even your paycheck tax withholding all move when your relationship status does. The best time to review your tax plan isn't after, it's during these life transitions. And whether you are walking down the aisle or starting a new chapter, we help you make sure your taxes keep up with your life so that you can focus on everything that matters beyond the number. Thanks for watching. See you next time. And don't forget to like and subscribe for more tax tips that are legal, practical, and intentional.